Okay, let's talk about the Fed rate cut. We all know it happened, not a big surprise. But one thing I want to talk about here is where the Fed projects things are going right now, because that's kind of the most interesting part of this story. Jerome Powell said in his speech that they predict the federal funds rate is going to be at 3.6% by the end of this year. Right now, they just lowered it to 4 or 4.25. They're talking a couple more rate cuts at least in order to get there by the end of this year, which is not that far away. Then they're talking only 3.4 percentage points by the end of next year, which means that next year there probably won't be very many rate cuts, maybe just a couple, and just kind of wait and see how these rate cuts have an effect on the economy, sort of like what they did for the majority of this year. Then he says by the end of 2027, the federal funds rate is projected to be 3.1%. So basically, they're kind of committing to a long-term strategy here of cutting interest rates over the next 2 years at a time when inflation is going up. So what does that mean for you? Well, it means that you better have some way to hedge against it, because inflation is guaranteed to be putting a bigger and bigger hole in your pocket month over month and year over year right now. And this decision to cut rates was pretty much unanimous. 11 of the 12 Fed members voted to do this quarter point rate cut. There was only one dissenter, Stephen Moran, who actually was in favor of an even larger rate cut at 50 basis points. Now, if we look at this chart right here, this is something interesting. This shows us the last 4 rate cutting cycles, including this one, going all the way back to the year 2000. And what do you guys notice? Every time the Fed starts cutting rates, shortly after that, you see this gray line. And that gray line is an official recession, which means that most likely that's where we're headed right now, is into official recession territory. Jerome Powell said that the decline in job growth and the labor force participation has gotten everyone's attention. And he's now saying that the downside risk is a reality and is signaling us away from the inflation first fight onto the concerns of how fragile the job market is. So Jerome Powell essentially stated that there's no risk-free path, and he's acknowledging that there's a trade-off between inflation and jobs right now. And due to their dual mandate, they believe that there's more risk in the labor market than there is with inflation. He's insisting this decision was not made because of political pressure. This was made because this just seemed like the right thing to do. And he says he thinks that they were right in waiting to do anything throughout the year, and only now seems to be like the right time to be dropping interest rates. What do you guys think about that? Jerome Powell also thinks it's going to be easier to manage inflation moving forward, even though somehow over the past 4 years they haven't been able to lower inflation down to their 2% goal. They're still sitting at 3%, so it was so easy to get it down to their goal, even though they didn't reach the goal. And now they're kind of abandoning this in favor of trying to boost the labor market. And just like I said the other day, are these rate cuts really going to boost the labor market? Probably not. Are companies going to magically start hiring more people just because interest rates went down a quarter point? Doubtful. You know who else is doubtful that any of this is going to do anything besides raise inflation? Our bond investors, because the 10-year Treasury went down and then it went right back up, and it's sitting right now, as I'm recording this video, at about 4.1%. And you guys can see this is the Treasury chart going back about a year, which is when the Fed started cutting rates last year, roughly around September of 2024. And what do you notice? Ever since they started cutting rates in September of 2024, the 10-year Treasury has been significantly higher than it was a year ago, even peaking at about 5% towards the beginning of this year. I know 4.1% is not 5%, but it could easily continue going up if inflation continues to be a major problem. And some people say that, well, Michael, you talk about all the problems, but you never give us any solutions. Well, that's not true at all. I actually give solutions all the time in my videos, but like I said, most people don't stick around and watch the full 20 or 23 minutes, whatever the video is. People typically watch 5 to 7 minutes and then they're out. So you probably don't hear what I'm actually telling you. So for anybody who is listening right now, I will tell you what you should be doing is you should invest as much money as you can, essentially, into gold, into silver, into gold stocks, if that's your thing, or ETFs. Not my thing. I prefer physical metals, but hey, it's better than not owning anything related to gold. Buy the gold mining companies, guys. Why? Because gold and silver are the only real money that we have in this society. And every time inflation goes up, the value of gold and silver goes up along with it. And that's why fears of inflation are surging right now, because people are realizing that the jig is up. You know, the Fed has officially abandoned its fight on inflation with this latest interest rate cut and is now more concerned about the labor market, which they should be concerned about it. But what good does a job do you if the money you're making is not enough to even pay for normal everyday life, right? So in my opinion, inflation should always be priority number one, but hey, I don't work at the Fed. In fact, the bond markets were predicting that inflation would average 2.4% over the next 5 years. Well, now they're predicting that it's going to average 2.5% over the next 5 years. And that's just an average over 5 years, which is still clearly way above the 2% we're supposed to be at. And these 5-year inflation predictions are now as high as they were since Liberation Day, when the Trump administration announced all of the new tariffs that we have. Even the Federal Reserve's official predictions don't see inflation coming back down to the official 2% target before 2028. So what are they doing cutting rates, guys? Like, doesn't anybody see how hypocritical this is? Why on earth would you be cutting rates if inflation, by your own prediction, isn't even projected to reach the levels that you're trying to get it at until the end of 2028? I mean, how far away is that? We're talking at least 3 more years, and inflation has officially been a problem since 2022, when it peaked at 9.1% CPI. So you're telling me that everybody's supposed to wait a minimum of 6 years to have inflation go from 9.1% down to 2%? Imagine how much money and how much purchasing power you will have lost throughout those 6 years. Or what if you are somebody who's retired right now, trying to live on a fixed income, trying to make sure that your assets are keeping up the pace with inflation? Well, good luck with that. Even the cost of living increases that people are getting on Social Security are not enough to keep up with these inflation numbers. Even Jerome Powell says that we are at a risk of a stagflation style economy right now, which is where growth basically comes to a screeching halt, economic growth, and inflation continues to go up. It looks like we're already there. We're already in the light stages of stagflation right now. The question is it going to get worse or better? Well, if they keep making foolish moves like this, it's probably just going to continue to get worse. And the other thing that we need to talk about is inflation doesn't hit everybody the same, okay? People are not equally affected by inflation because it really highly depends on where you live. It depends on your lifestyle, the type of things that you buy, whatever, your standard of living. All of this really highly depends on what level of inflation that you personally experience, okay? But according to a new Wallet Hub study, they compared 23 major metropolitan areas using key consumer price metrics like changes over the past 2 months and over the past year. And here's what they found. Metropolitan areas in Florida and California are experiencing the most severe inflation problems, with rates almost double the target rate of 2%, meaning that in most of California and Florida, you're easily feeling about a 4% inflation rate right now, probably even more than that, because this is all using official data. They say that San Diego, California is ground zero for inflation right now, where people there are experiencing about a 4% year-over-year inflation rate. Tampa, Florida is not far behind at a 3.3% year-over-year inflation rate. Philadelphia is experiencing a 3.3% inflation rate right now. Anchorage, Alaska, they're at 2.4%, and Chicago is at 3.1%. The New York and New Jersey metropolitan area, they're at about a 3.2% annual inflation rate right now. But if you live in Texas, for example, in Dallas-Fort Worth, then you're only experiencing an average of about a 0.9% annual inflation rate, which is not nearly as bad as some of these other areas we talked about. I remember just a year ago that Miami was at the top of this list, where Miami was experiencing the highest inflation rate in the nation. So it's like, it doesn't even really matter what the official numbers are, because you can take whatever the official numbers are and double or triple them. And then depending on where you live, tack on the extra there. But don't worry, we got to save the job market, because without a job, nobody's going to be able to pay for all this ridiculous inflation. So I think that's where the motivation really comes in. When you start seeing the full picture, it's like, well, they want people to have jobs, because if they have jobs, then they can pay for all of the inflation, or at least they can try to keep up with paying for it. Versus if people don't have jobs and we're experiencing all this inflation, then inevitably we're going to have to go to deflation, because it's going to be the only way that anyone's going to be able to afford anything. So I feel like this rate cutting cycle is more of a reflection of the ultimate motives of the Fed and the government, which is just to kind of keep you just poor enough where you can continue making some payments and keeping up with a lot of the inflation, but not all of it, and still in general falling behind, but not too far behind, so you can still spend some money in the economy.